So, ladies and gentlemen, want to thank you all for joining our EY Kenya Budget Breakfast 2021-2022. We are very glad to have you all. Thank you for joining from wherever you are. We have a wonderful panel of experts who are going to engage you today. We'll make this exactly 2 hours as promised. So sit back and enjoy. We're on live on YouTube, on Facebook, and on Zoom. So please feel free to engage with us. Let's have a conversation. It's not just about us here, but about you seated at home or in your offices. Karibuni sana. At this juncture, I would like to introduce and welcome the EY East Africa CEO and Kenya country managing partner, Nancy Muhwaya, to come and give you an official welcome. Let me say something small about Nancy. Nancy is a homegrown and seasoned accountant who has worked her way up the corporate ladder at East Africa for the last 17 years in various leadership capacities. She has served as a partner and leader of Assurance Service Line in EY East Africa, where she has registered commendable performance and growth of our business. And you are going to see that performance even in the way that her people conduct this event today. I'm therefore pleased to invite Nancy Muhwaya to come and give our delegates and our guests a warm welcome to our event. I therefore pronounce the EY East Africa Breakfast 2021-2022 officially open. Thank you.
Thank you very much, Edith, for the very colorful introduction. Distinguished guests, ladies and gentlemen, it's my pleasure to welcome you to EY's 2021 Annual Budget Seminar. EY has, over the last 20 years, held this event on an annual basis. Like last year, and thanks to technology, we again this year are holding this very important event virtually. Let me tell you something about EY. I know most of you already work with us, but allow me to take a few minutes and tell you about EY. We are a global leader in assurance, tax, consulting, and transaction advisory services. Around the world, we employ over 280,000 people working within our global organization. And they work across 150 countries. And in fact, those 150 countries, we have more than 700 offices. And guess what? We serve more than 220,000 clients. In Eastern Africa, we have been around for over 87 years. And thus, we have acquired experience in the region's business practice. EY has presence in Eastern Africa countries, of course, here in Kenya, Uganda, Rwanda, Tanzania. And we also have clients in Somalia, Ethiopia, Eritrea, Djibouti, and South Sudan. We serve these from our Nairobi office. Further, we have clients in Burundi, and we serve them from our Kigali office. Our purpose of building a better working world inspires our everyday actions. It also inspires all our decisions. In short, it explains the why we do everything that we do. We are committed to doing our part in building a better working world. Our ambition is to create a long-term value, or to create long-term value to our clients, our clients, to our people, to societies, and to capital markets. We want to be the most trusted, distinctive professional services organization. Right? The insights and quality services that we deliver help to build trust and confidence in the capital markets. In short, we do understand that we're in the business of selling trust. We develop outstanding leaders. We wouldn't do so without developing outstanding leaders and teams who create long-term value for all our stakeholders. And of course, this leads to sustainable growth. Our values underpin our purpose and our ambition. Remember, I mentioned to you that our purpose is to build a better working world. That would not be possible if we did not have our values. Our values underpin that purpose and that ambition to be the most distinctive professional services organization globally. And we are a people that demonstrate integrity. You expect that as our stakeholders. We demonstrate respect, teaming. And we are people with energy. You will see that from our conversations today. We demonstrate energy and we build relationships based on doing the right thing. As long as it's based on doing the right thing, we are in. Thank you for taking time out of your busy schedules to join us. Okay, even if virtually. And of course, amidst all the challenges that we are facing today. This goes a long way to demonstrate the resilience and a very strong signal that as a country, we are going to overcome this pandemic. On behalf of EY, I take this opportunity to appreciate each one of you for your continued partnership, individual relationships, and we do not take this for granted as a firm. In the last 14 months, actually since that was mid-March last year, we have all navigated the challenges of working under lockdowns and under other preventative measures together. And I really must thank you for this. Before we commence our event for today, I would like to acknowledge the presence of our partners here. Hadija, Anthony, Christopher, Robert, and of course our East tax leader, Francis Kamau. Francis' dedication on this cause is commendable, and actually he has been very consistent on that. He has worked around the clock for the last many days together with his team to ensure that we connect with you today. In the same breath, it's my honor to welcome our invited guests, speakers, and our senior EY practitioners who have worked tirelessly hard to make this event a success. Ladies and gentlemen, pursuant to the Public Finance Management Act, the National Treasury is required to submit to Parliament the budget estimates by 30th of April to allow for debate and public participation on the proposed law changes. And this ensures that the changes are enacted by 1st of July when the government fiscal year begins. And this is the reason for this meeting today. Ladies and gentlemen, like I mentioned, it's now just over a year since the COVID-19 pandemic struck. We have all witnessed this monster wreak havoc on our lives, on our economy, and as well as global economies at large. This pandemic has significantly affected businesses in various ways over the last year. And the state responded to this pandemic by enacting law changes to cushion both businesses and individuals. We shall hear further, especially on this from our panel experts who are here today. Like many other businesses, EY was not spared. We don't work in a vacuum. We were not spared from the effects of this pandemic. We had to quickly learn the ropes of working remotely to fully embrace technology to ensure our mandate. And when I talk of our mandate, it's all about you as our clients. Our mandate to continue delivering exceptional client service. Our mandate to continue selling trust and confidence. And our purpose of building a better working world to you as our clients. This year's budget, like last year, it's been presented amidst a subdued local business environment. And of course, this speaks to the global disruption, disruption in the global supply chain. It speaks to the grounded forex inflows. We have seen witnessed shortfall in demand of Kenya export goods. The Kenya shilling looks to be, weakening. We'll hear some more on that. Tourism earnings, and of course, job uncertainties. However, while the above amongst other factors have threatened the stability of key macroeconomic indicators, There's so much hope. The economists are calling it rebound. There's so much hope to reverse the negative impact. In fact, when you listen to IMF, the global economy is still projected to record a higher growth compared to last year due to, of course, all the preventative measures that have been taken, and more so, speaking to vaccine, wider vaccine coverage. You'll agree with me that we have got our unique problems, our hesitation around uptake of vaccine in Africa. But speaking of that higher growth, does that surprise you? Our panelists will be speaking some more. As I conclude, ladies and gentlemen, reflecting in the past year, critical lessons we have learned, and there are many certainties, there are still many certainties ahead of us. But I believe that we are at a better place than we were a year ago. In my own words, there's light within the tunnel. So I want to thank you very much for attending to listen to our technical experts and guest speakers as they analyze this year's budget event. And of course, there will be a session for question and answers. You're most welcome. Thank you.
Thank you very much, Nancy. This new life of ours is very hard, Sanitizing, sometimes we forget, we talk with a mask. And today we have very many doctors in the room, so we have to be at our best behavior. So make sure the team that is around, make sure you're in your mask throughout, make sure you're sanitizing. Thank you very much. Now at this point, we're going to go straight into the main program, and we are going to dive into the tax highlights. And I'm going to invite Grace Mulinge to give us the tax highlights from a Kenyan point of view. And then after she's done, we're going to also listen to our colleagues around East Africa also as they share their tax highlights. So Grace Mulinge is an associate partner in our tax team, and she's also an advocate of the High Court of Kenya. She has quite a CV, but she's very humble. She has told me to just say those two things, and I will respect that because I need my job. So Grace Mulinge, please come and give us tax highlights from Kenya.
All right, good morning, everyone. I will be taking us through some of the changes we anticipate. We are all aware that the Cabinet Secretary in charge of the National Treasury last week on Thursday presented the budget estimates as well as a finance bill to Parliament. Now, we expected the finance bill to have been out on Friday as well as yesterday, but unfortunately we don't have it. So what I'll be taking us through is some of what we've heard through the media, some of the discussions we've had in Treasury, and some of the proposals that we have submitted following the amendments over the last 2 years, where we have seen gaps in some of the laws. And you will agree with me as I go through some of these proposals that some of you in the audience have also submitted proposals to Treasury. And we hope that some of these will go through the Finance Bill and finally through the Finance Act. So I will start off with minimum tax. I know we are all aware that we have conservatory orders, and therefore the implementation of the provision on minimum tax is currently suspended temporarily until we have the final judgment. But in the meantime, as the case was in court, we had also submitted proposals to Treasury. And some of the challenges we are seeing around minimum tax would be particularly for loss-making companies that are loss-making because of investment deductions. So for companies that have carried forward losses over the last couple of years because of investment deductions, it is not clear what then happens to the losses they have made and how they recoup their investment deduction. So we obviously are looking to, an amendment to allow investors to recoup their costs of investment. And, it's also against the second schedule where we have investment deductions. So the government gives a deduction on the one hand and then takes it away on the other by requiring taxpayers to pay minimum tax. There's also a problem when it comes to offset. If in a particular year of income, so for half the year you've made losses and the other half you have made a profit, it then becomes very difficult to reconcile and to know whether you'll be able to claim your credits when you're finally paying your final tax balance at the end of the year. On the investment allowances, the second schedule was overhauled. We didn't have any transition clauses. So for various assets that we have that were in different classes, they've now been all classified under two classes. It's not clear what then happens to investment deductions which had already been claimed and how those will continue to be claimed moving forward. We didn't have any transition clauses. And even as the second schedule was overhauled, we lost a few definitions which were very critical. And one of the ones that we lost was a definition on farm works deduction. We don't know what that is anymore because it's not in the law. We also need a definition for the word control. This has a great impact on transfer pricing, thing capitalization. So this is also not in the law. We have submitted proposals to the National Treasury, and we hope that these are some of the changes we'll be able to see in the finance bill. On the tax rate, there's also inequity, as we have all seen, because the law has changed over the last year from 25% to 30, well, rather from 30 to 25% and then back to 30. So companies with December year-ends will be able to pay tax at 25%, but those that have a different year-end will be paying tax at both 25 and 30. We all agree tax rates need to be equitable, so we are also expecting a change on that, clarity on that. Again, under income tax, we've had discussions in the media. There's a proposal to incentivize the technical training institutes so that they can recruit graduates. We potentially expect to see this in the finance bill. There was also another rebate that we've had before. That has been successful, especially within the health sector. We are not too sure about other sectors, but we are aware lots of graduates were recruited, and the health institutions have taken advantage of the rebate that had been granted under law. The draft income tax bill. Now, we saw this about 3 years ago when it was released for public participation. We don't know what the status is. There are still many changes that are going through the Income Tax Act, and we expect and hope that we will finally have the income tax bill out so that instead of having piecemeal changes in the Income Tax Act. There have been very many discussions on the digital economy and taxation of the digital economy and those that are transacting through the digital marketplace. There's still a lot of clarity that we require around this. There was a summit that the KRA had not too long ago. And one of the things they're trying to do is also to get feedback from taxpayers on the laws as they are, the ability to implement the laws. But we have also sent proposals to Treasury on some of the challenges. But the question we're asking ourselves is whether we also expect tightened regulations, especially for non-resident players who are benefiting a lot from the digital economy. But then also there could be a negative impact on trading in the digital marketplace, but that would be a wait and see. We'll wait and see whether the taxes will have an impact. On personal income taxes, we've also had a discussion, we saw it in the media, on possibility of introduction of the wealth tax, maybe akin to what we have in the UK. We don't know whether it'll be a one-off tax. We don't know whether it'll be a transfer tax, but there have been discussions, and we expect to see a change in the law. Do we expect a reintroduction of the Robin Hood tax? Remember, we have all seen a statement again in the media that the Income Tax Act, the Value Added Tax Act, the Tax Procedures Act, the Insurance Act, the Central Depositories Act, the Capital Markets Authorities Act, all these acts will be changed. So, we're expecting very many changes. The Excise Act, the Retirement Benefits Authorities Act. So we are really just anticipating some of these changes. The Robin Hood tax had been introduced about 2 years ago, and then that was shelved. It was a transaction tax, 0.5% on all our bank transactions. To meet the budget of 3.6 trillion, we don't know whether this will be reintroduced. On employee matters, there was a time the government had proposed to increase the highest tax bracket to 35%. We are aware that the highest across the East Africa region is 40%. In other countries, it's gotten to 50%. It could potentially target the high net worth individuals. We hope that this doesn't change and we remain at 30%, but those are some of the possibilities that the government is using to raise its, to be able to meet its budget. We also have seen a discussion on the Unemployment Insurance Fund, where there's a proposal for employers and employees to contribute 1% every month. There's also been proposals which were submitted to the National Treasury, and I know the Kenya Association of Manufacturers were also part of those proposals. That has not yet been implemented, but could potentially come through the changes that we're expecting. Do we expect any deductions or reliefs for employees? Highly unlikely, because we saw these being taken away over the last 1 year through the changes that have come through the Finance Act and the Tax Amendments Laws Act. Under the Tax Procedures Act, some of our concerns, which are also being discussed with Treasury, is enforcing of the tax, a ruling from the Tax Appeals Tribunal. We are seeing KRA immediately issuing agency notices to banks, which is very unfair because the law is very clear that a taxpayer has leeway to put in an appeal within 30 days. So we're also expecting the KRA to respect the law and to allow taxpayers to have the full, to follow through the full procedure that's within the law before agency notices are issued. On claim of overpaid tax, it's now clearer that taxpayers who have overpaid tax are able to utilize the overpaid tax except through a formal application to the KRA. This is also quite punitive for taxpayers because we are a self-assessment regime, and it's a trust relationship that we have with the KRA when we self-assess. So the KRA should actually allow us and allow taxpayers to offset overpayments. After all, it's the clients who were estimating the tax that was due. And so if your circumstances financially allow you to pay less tax at the end of the year, then you should be able to offset against overpayment of taxes. And we hope that can also be changed as we move forward. On value-added tax, there have been quiet, closed-door discussions on harmonizing the standard VAT rate across the East Africa region. We are aware that the highest rate currently is 18%. We are at 16 in Kenya. We could potentially see an increase to 18%, but we hope that that doesn't happen. We are also aware, this is not a change. This is to point out what's happening on 1st of July. Liquefied gas will be taxable effective 1st July. This is an amendment that had been passed in June 2020. We also expect exemption of VAT on ventilators, supplements, and decongestants, and also just PPEs generally. VAT refunds, last year the government allocated about, I think, 10 billion to allow the KRA to refund VAT to taxpayers. I don't think that was enough for our taxpayers to get back their refunds, so we expect the government to allocate a high amount to this because taxpayers need this money for cash flow needs. On the digital marketplace regulations, indirect tax, there are also a lot of gaps. And one of the gaps that is seemingly coming out is the threshold for purposes of charging VAT on services in the digital marketplace. In our view, the law applies, and it's currently at 5 million when you're required to register for VAT. And this should be consistent even for purposes of the DST regulations. But these are discussions that are ongoing with the KRA and also with Treasury, and we hope for clarity. Electronic tax invoicing, so effective September 2020, the regulations that all taxpayers need to comply with the electronic tax invoicing. There's a 12-month window for this compliance, but we're expecting administrative guidelines. We haven't seen this yet, and this is May. So we hope that these will also come through either the finance bill or other regulations, but in time for clients to be able to comply and change their systems accordingly. On the VAT auto assessments, we are still having a lot of challenges. It's very difficult for taxpayers who want to claim their input tax to be able to control what the supplier does. It's very difficult for a taxpayer to be a watchdog over the supplier, to allow them to claim their input tax. They've already borne that cost, and it's pretty unfair for the law to expect a taxpayer to only claim the input tax once the supplier has declared on their part. Under excise and customs duty, one of the changes, again, this is not a potential change, this has already happened. In May 2020, the commissioner had given a directive that certain goods which are imported into the country would not be warehoused. And this was very difficult for taxpayers because then it would mean that they needed to pay tax. Immediately, these goods are in the country, but fortunately, the restriction was lifted effective April 2021. Now, under the levies regulations, we're also expecting changes around that, which will obviously affect the systems, client systems. But what we are also seeing as a challenge over the years is for inflationary adjustments. So we have the finance bill, and then in June, we have levies which have either increased, well, often increased, not decreased, and taxpayers have to upgrade their systems to accommodate those changes. And then inflationary adjustments take effect in September, and after that, clients have to adjust their systems again. So if, the two could also be harmonized so that it doesn't cost the taxpayer too much, and it's also not an administrative burden, that would be welcome by the taxpayers. So, overall, those are the discussions we have submitted, we're having with Treasury We have submitted through ISPAC, through our individual organizations, and we hope to see some of those changes through the finance bill. Now, the other point I would like to highlight is security lending. We have also seen this piloted by the CMA. The NSC needs to remain active, so we hope that this will also, the laws will be promulgated, and we will see some changes through the finance bill. This is, so that's, would be it on the levies and the customs area. On the insurance sector, we've seen lots of changes around the products that are provided, and what we potentially expect to see is also laws that govern taxation of some of the products, the new products that we're seeing in the market. Thank you very much.
All right, thank you so much, Grace, for giving us an elaborate highlight of the tax highlights from Kenya. Now we are going to go to Tanzania and get to hear what is happening on that side. As Grace said when she began her presentation, we actually do not have the finance bill. So I would like to emphasize on that. We still don't have it. It's not in the public yet, but we hope to get it soon. So can we go to Tanzania? Innocent? Just 1 second, our technical team is trying to establish the challenge.
By the year 2025. So the vision is built on 3 pillars.
All right, as we sort that out, I would like to ask that we engage with our, let's engage with our teams, and also feel free to tweet, hashtag Better Working World. Okay, so Innocent, tax highlights from Tanzania. Sorry about that. We are trying our best to see that we get the sound right. And our team is doing the best it can. Okay, so maybe we can begin with, we can go to Uganda first as we sort out Tanzania.
Alan Mujisha, associate partner based in Uganda, and I'll take you through the key tax highlights
So,
from the
Alan?
Uganda Tax Amendment Bill and what the different aspects that they tend to achieve. What has
Alan,
happened
we are-
uniquely this year is that we have so many far-reaching tax amendments covering a couple of tax heads, and I'll just pick the key silent features. We can't go into each of them in nitty-gritties. However, I'm always available should you require any further clarification. So these particular tax amendment bills are covering a number of tax heads, namely the Tax Procedures Code, Amendment Bill 2021, VAT Amendment Bill 2021, Income Tax Amendment Bill 2021, Stamp Duty Amendment Bill 2021, Tax Appeals Tribunal Amendment Bill 2021, Excise Duty Amendment Bill 2021, External Trade Bill 2021, Mining Amendment Bill 2021, and Fish Amendment Bill 2021. So I'll start with the major aspect on the Tax Procedures Code. I think what we're seeing here is that the law seeks to amend the definition of tax decision. We're also basically seeing that going forward, there will be non-issuance of licenses to taxpayers that do not have tax identification numbers. We're also seeing tax introduction of new penalties in relation to digital tax. And this one basically is mainly concerning the digital tax stamps. But we're also going to see the increased time framework for amending tax returns from 3 to 6 months. We're also seeing introduction of alternative dispute resolution of tax disputes after objection decision. I think this has been quite a thorny issue because most of the cases take long in the tax appeal tribunal, and if you have to go to High Court, it takes a much longer period. So we are seeing the law seeking to introduce alternative dispute resolution with anticipation that this one will basically reduce the time for tax controversy. We're also seeing a repeal of the various liability rule, but we're also seeing going forward, there's going to be increased powers of the commissioner during tax investigation, and where we can understand where this one is coming from. It's basically mainly what we're doing, digital tax stamps, and digital tax space requires quick action, and any late action may lead to information being lost. But we're also seeing that for some aspects of tax disputes, there will be more penalties being introduced. When we got VAT, I think we are seeing that going forward, there's a clarification of VAT on imported services. And what the law is basically saying that if a service was exempt, if it was a local service, then if it's imported, it should get the similar treatment. We are also seeing that there will be 6 months from the date of invoice time limit for claiming input tax credit. And this one is a good innovation. But we're also seeing that for some tax heads, especially for non-residents, there will basically be introduction of quarterly VAT returns for specific sectors. It doesn't apply to all sectors, but only just a few specific sectors, things like royalties and performers and things like that. But, going forward, the bill proposed to introduce VAT on purchases as a refund, provided it qualify for some conditions that are specified by the Commissioner General. However, again, this one is subject to the Commissioner General being satisfied, but you where you purchase from and you as the purchaser, you qualify under that rule. We're also seeing that there is a particular clause in the VAT which gave the powers the commissioner to to charge additional penalty if you gave them a misleading information knowingly. We are seeing that provision being peeled out. What we're also seeing that going forward, there's also going to be addition of exempt public international organization, and this one was mainly driven by Afrexim Bank and one of the nature stamps and entities digital tax space requires quick action and any late action may lead to as a normal routine. We're basically going to see that. But also seeing that exempt surprise and zero-rated surprise are being modified. There will be to affect to reflect penalties, increasing dynamics in the economy. When we got VAT, on the income tax amendment bill. There's a clarification of VAT again unique with other developments arising out of if a service was exempt, if the need to comply and align our laws with international treatment. And we are also seeing that there will be 6 months from the date of invoice time limit for claiming input tax credit, and this one is a good innovation. But we're also seeing that for some tax heads, especially for non-residents, there will basically be introduction of quarterly VAT returns for specific sectors. It doesn't apply to all sectors, but only just a few specific sectors, things like royalties and performers and things like that. But, going forward, the bill proposes to introduce VAT on purchases as a refund, provided it qualify for some conditions that are specified by the Commissioner General. However, again, this one is subject to the Commissioner General being satisfied that you where you purchase from and you as the purchaser, you qualify under that rule. What we're also seeing that there is a particular clause in the VAT which gave the powers the commissioner to charge additional penalty if you gave them a misleading information knowingly. We are seeing that provision being peeled out. What we're also seeing that going forward, there's also going to be addition of exempt public international organization, and this one was mainly driven by Afrexim Bank and one of the nature entities that have set up in Uganda. As usual, as a normal routine, we're basically going to see that the exempt surprise and zero-rated surprise are being modified to reflect the increasing dynamics in the economy. On the income tax amendment bill, again unique with other developments arising out of the need to comply and align our laws with international and double tax treaties. We are basically seeing the redefining of the beneficial owner, and here they are basically extending it to individuals who can influence activities in an entity, but it also goes to touch on the trusts and some of the other entities. Again, also, we are seeing the amendment bill seeking to redefine the definition of consideration and make it as broad as possible. And I think this is basically in line with normal trends that we are seeing arising out of new developments in tax space. We're also seeing that the bill also seeks to redefine exempt organizations. Again, this is also as part of the normal trend. But what's quite unique in this bill, we are for the rental deductions, these ones are being capped to 60% of the expenses. And why I'm saying it's quite unique, this is the only sector where we are seeing the expenses being capped. But also on the same line on the rental, we are seeing that going forward, the law seeks to harmonize the rental tax 30%, whether you are an individual or corporate entity. In the past, I think individuals had a better rate at 20%. We're also seeing that there's also going to be revised tax exemption requirements for investors who are investing mainly in some of the entities for them to be exempt. Again, we are basically seeing that the agro-processing exemption that was initially available to taxpayers in that sector is basically being repealed. But also what is also kind of unique in this amendment bill is that there's going to be a reclassification of depreciable assets into 3 classes. Initially, there were 4 classes. We're also seeing that the bill seeks to introduce withholding tax exemption for purchase of assets of an asset from a non-resident. Again, this is it's a welcome measure because that withholding tax was increasing the cost of the asset. The bill also seeks to defer the claiming of initial allowance of depreciable assets and industrial building for our next year, the year following the year in which they are acquired. Again, this is a new development, but also seeing that the bill seeks to introduce adjusting asset cost base using for purposes of computing CGT, using indexation. Again, for the case of venture capital funds, if you invest 50% of the proceeds from your fund, you would basically, if the bill is passed, you wouldn't basically be subjected to capital gains. There's also going to be automatic exchange of information in international agreements. Again, this affects a couple of people having cross-border transaction, because what we're basically saying is the moment you have transactions in Uganda, you need to be aware that at any point in time, there's going to be automatic exchange of information with other tax jurisdictions. I think as we stand now, the government and Revenue Authority have signed a number of mutual exchange information, and we are about to see these ones coming up in the next year if the bill is passed as it is. We're also seeing the bill introducing the due date for payment being the same as the due date of filing the returns. Again, we also see some deemed date for submission of refund applications, but also we're going to see increased tax exempt organization, like I had earlier highlighted when I was talking about VAT, and this was going to basically mean affect Afreximbank and one of the international nature organizations. Now, when it comes to stamp duty, we're going to basically see a number of stamp duty provisions, and here we're basically saying that there's going to be a reduced percentage of raw material for use in industrial parks and free zones. Initially it was 70%, but we're going to see it being reduced to around 50%. We're also going to see increased number of citizens being employed for one to qualify for exemption in industrial park from 70 to 100. We're also seeing the stamp duty exemptions on debentures, further charges, lease land, increase of share capital, transfer of land, agreement to conduct feasibility study executed by manufacturers whose investment in capital is at least $50 million, or a manufacturer that makes an additional investment equivalent to $50 million. Again, we're going to see a number of changes and the waiver of stamp duty. When it comes to excise duty amendments, we're seeing a number of new provisions, and we're saying that there's going to be no requirements to renew a certificate register for providers of accessible goods or services. We're seeing the remission of excise duty paid on plastic packaging used in exports, medicaments, or manufactured from recycled plastics, equivalent to at least 50% of the raw materials. We're also going to see the introduction of excise duty rates on other alcoholic beverages, plastics, internet data other than fragmented beverages, and wheat grain. I think what's unique, that whereas government is waiving or repealing the OTT services on data, we are seeing a 12% duty being imposed on internet, which is quite, again, is going to be quite punitive on most of the sectors that are relying on internet for both business and innovation. Again, when it comes to tax appeals tribunal, we are seeing that initially there was a limitation of appeal, but right now there's going to be a right to appeal from decisions of the High Court and Court of Appeal. I think initially what the law had basically provided for was that if you are, the Tax Appeals Tribunal was the court of first resort, and there was some limited provisions for you to appeal, but right now we're seeing there is more provisions for taxpayers to appeal. But also once you appeal to higher courts, those higher courts have got the power to stay for the self-execution of pending the appeal. Also, what the bill also proposed.
Okay, thanks, Alan. So what we are going to do is we are going to share the video recordings of the tax highlights from the region so that you can have time to listen to them and internalize. And we will definitely be available for any questions that you may have. So I think without further ado, we are going to go into our panel session. Our panel session was beginning at 9:30. This is 9:32. It's a very important part of this breakfast event. And I will invite the panelists to walk to the front as I introduce them. Then we can begin. So, Francis Kamau will be a panelist today. Francis is the EY East Africa tax leader and partner. We call him the tax guru. He has played in this field for quite a bit of time. I always say when you wake up Francis in the middle of the night and ask him any tax question, you're sure you will get an answer. So thank you for being with us today, Francis. Our next panelist is Dr. Elizabeth Walla. Many of you know Elizabeth Walla. She's a very soft-spoken, yet still a very determined and courageous lady. She's a health system and strengthening expert who is very passionate about global health and decolonization of health systems. And one of her career highlights is being selected as a Business Daily Top 40 Under 40 in recognition of her leadership skills. Currently, Dr. Walla is a global advisor health and nutrition at Aga Khan Foundation. Thank you for being with us today, Daktari. I'm so happy to meet you in person, personally. Next panelist is Ken Gishinga. Ken Gishinga is the chief economist at Mentoria Economics. His primary role is to enable clients to discover opportunities in the new economy. Ken, we like to say, and we don't say, is a graduate of Harvard University. And also, yeah, Ken, you need to remove your mask so that I can repeat that. I like to say that. I mean, give credit where it's due. So Ken Gishinga, I say again, is a graduate of Harvard University and a recipient of the Business Daily Top 40 Under 40 Award. So thank you very much for being with us, Ken. This is the third year you're with us as a panelist, and we really appreciate your time. Our next panelist is Dr. Gasheri Thuku. Dr. Gasheri Thuku is a dental surgeon who decided to abandon her profession and turn out to be a manufacturer. She's very passionate about Africa, its women, the youth, and its leadership. Currently, she is the CEO of Sheth Naturals, a natural hair and skincare brand created for Africans by an African woman. And you can be sure many of us, from what you're seeing on the screen, we are beneficiaries of her products. And I also take this opportunity to encourage the rest of you to also try and benefit from her products. So Dr. Gasheri, thank you for being with us today. We are happy to have you. Next, we have Dr. Alex Awiti. Now, Dr. Alex Awiti is the Vice Provost at Aga Khan University. He has been there since 2018. Dr. Awiti, for those who follow him, he calls himself a scholar, and indeed he is. He is an interdisciplinary scholar who has had done extensive research in very many areas, from agriculture to ecology to education to climate, society, health policy, economy, etc. Dr. Awiti is an adjunct professor also in the Department of Geography and Environment at the University of Fraser Valley in Canada. Thank you so much, Dr. Awiti, for accepting to be with us today. Your CV is quite long. I'm very tempted to go on and on, but please follow our panelists, even as we go on Twitter, on LinkedIn, and they will be happy to engage you. Now, last but not least, we have our moderator for the day. Our moderator is Robert Nyamu. Robert Nyamu is a partner at EY, and he's also EY's technology consulting leader for East Africa, responsible for a diverse range of technology-enabled business transformation solutions. He has provided a wide array of transformation services to many of the leading blue chip companies. Many of you who are watching are his clients, and you can attest to that, as well as very key government institutions across East Africa region and beyond. Robert is a certified information systems professional and also a chartered accountant. So, ladies and gentlemen, thank you so much for being with us today once again. And for those who are watching, you will definitely enjoy the panel discussion. I'm also looking forward to it. So I will hand over the program to Robert Nyamu, and he will be the driver. He will tell us what next. Enjoy, interact with us, ask questions, and follow us on our hashtag, Better Working World. Thank you.
All right, thank you very much, Edith, for that very warm introduction, and welcome to the panel. I think as you've all heard, we have a very exciting panel with us here today, and we hope to engage you on some very pertinent topics of the day affecting our everyday lives and our economy, etc. So without further ado, I think in no particular order, maybe that's what happens when you sit next to the moderator. Maybe I'll start with you, Dr. Awiti. And I heard that you're, from your profile, you're an intellectual of many fields, which is always a good thing. So I think we'll benefit from having your views on a number of topics here today. So if I can just start off with the key issue of the day that we're facing and a lot of countries around the world are facing. And this is around the pandemic. And there's a big debate happening as to which countries are getting it right, which countries are, on the mark, which ones are off the mark, and nobody knows the way forward. And I just wanted to pick up from you in terms of, I think for us, it was mid-March when we recorded our first case, and we've gone through a series of trial and error, if you can call it that, and quite a few. I think we're on our third wave now, is it? And we've opened up again on Saturday. Probably a populist move, if you like. So I just wanted to pick up your views, Dr. Awiti, on how we are faring so far, because that is such a critical thing and affects so many other aspects of our socioeconomic life, including the economy that we're going to discuss here today. So I wanted to start off with you and pick your views on how you think we're faring so far and what the government can do as far as containment measures and other measures around addressing the pandemic are concerned. Dr. Awiti.
Thank you very much, Robert, and it's a pleasure to be at this event. Thanks to Ernst & Young for inviting me. I think when it comes to the pandemic and the global response, and if you boil that down to national response and the structure of the epidemiology at a national level, the global response was tepid, and I think to be bold and blunt, it was disappointing in many senses, because we saw everybody retreating to national corners. And there was a bit of nationalism around the initial parts of the process to try and even get to grips with this. And we've seen full-blown vaccine nationalism in terms of those who pre-ordered, pre-purchased, and financed the process of vaccine development in many respects. But if you look at that, even in the period before the vaccines were actually rolled out in December, January, and now in Kenya in March, I think no one is winning this battle. If you see the epicenter of the epidemic and how it has moved from Wuhan, where it started, to Lombardy in Italy, to Europe, to the United States at the same time, to Brazil, and now more recently, the epicenter of the global epidemic, kicking up a surge in numbers, is India, that came from 10,000, Modi declared victory, and now everybody is starting to think about what does this really mean for the world. The Indian variant has been detected in other countries, even when everybody's been moving really fast to cut India out of the global circuit. I think nobody knew how to deal with this pandemic of this scale. 1918 was the last time we had the Spanish flu, and everybody who was in that and dealt with it is dead or just about to die. So this is brand new, and I think the global infrastructure of international governance broke down. WHO has zero credibility. The body language, the actions of the so-called G7 and the G8 has not been particularly sensitive to the plight of African countries. But the saving grace is that outside South Africa, the virus has basically spared the rest of Africa. But now we don't know whether in this third wave is the beginning of a surge. But we also don't take very good data. But early in the pandemic, a study that was done by Kemri showed that by May of last year, about 1.5 million Kenyans had actually had COVID antibodies. That means they were already infected. Now, if we go on to do this antibody test, we'll be very surprised. So I think in the main, Kenya is unscathed. I guess it's also the structure of the society, and part of the reason why we're at 160,000 and fewer deaths compared to everybody else is just because we're lucky. But I don't know how many more tries at not doing exactly what we need to do to stem the pandemic we will have before we have a full-blown scale of the pandemic, such as what we see in India.
Okay. Thank you for that. Thank you for those views, Dr. Awiti. And I think I'd like to switch gears, a lady this time, Dr. Wala. So I think Dr. Awiti has teed it off quite well. Coming back home here, what do you think our government should be doing more with respect to the measures? I know there's no probably one right answer, and we'd just like to hear from your expertise. What do you think the government can do more to bring this pandemic under containment?
Thank you very much. I think the government has really tried ever since we had our first case, I think, reported on March 6th of last year. But in addition, there's a lot more to do. One is that this is a pandemic. Yes, it is facing the health sector, but the impact is very devastating to many other sectors. And I think we've seen with the economy shutting down due to the measures that we've been put in place, it's not just a health issue, it's a global health security, it is an economic issue, it is a women agenda issue. So I think we're bringing everyone on the table to see how best to tackle it, whilst looking at the health measures and balancing that with livelihoods. The other thing the government really needs to do is to involve stakeholders that are not just in the mainstream public sector. We have private sector, we have faith-based organization, and especially in the health sector, where we see close to 49% of health services are offered by non-state actors. So especially when you look in the vaccine response, in the beginning it was, the people around the table were mostly public sector, government-driven, and private sector was given, again, the cold shoulder, so to speak. I think there's a lot of mistrust from the past. And this needs to be broken so that we have everyone working together towards that. We also need, it's a pandemic that is highly driven by behavior change. Now, unless we we get that behavior change communication right, where people learn that it is of their own benefit, not because there's a criminal offense or there's a consequence that is being driven by security forces, we're going to lose the war. And this is why we see in many situations, many of these directives are ignored because people have not understood that this is my responsibility and this is why I need to do it so that I protect myself, but I also protect the people around me. So I would say a multi-sectoral approach is very, very important in that we are going to curb the pandemic with vaccination, with the public health measures, but also ensuring that in the end we are not losing livelihoods as we are seeing at this time. Thank you.
Thank you very much, Dr. Wala. And I think this is an issue that a lot of countries are grappling with, and it has a direct impact on the economy. And I'll come to you, Ken. You always have very good views, interesting views around the economy. And maybe you can just take us through what you're thinking at the moment in terms of the pandemic. We've seen a stimulus package that was rolled out immediately. We recorded our first case last year, probably towards the end of March. And then it was rolled back. And again, the government is talking about additional stimulus measures. We don't know exactly where those will reach, but we know some of the areas. But maybe starting with the stimulus package that was rolled out around March, April of last year. Take us through your thought process around whether you think the government is doing enough. Are we stimulating the right areas of the economy, or are we skidding on the same spot? And what would you like to see more of?
Many thanks, Robert. Indeed, the last 1 year has been a period of soul searching. When the pandemic hit mid-March last year, there was that conversation that the fight will be along lives and livelihoods. And that was sort of like the global message. And we did see the government rolling out a stimulus package in May. It was about 52 billion shillings. And the central bank also put in some monetary stimulus of about 30 billion shillings. So we are talking of something around 82 billion shillings. Somewhere along the line, the conversation of lives and livelihoods, that philosophy changed. It almost became it's lives or livelihoods. And it's okay when you change your philosophy. I think my only problem was there was no clear explanation on how that shift took place at the highest levels of government. So we did see the fiscal tax, fiscal measures being put in place in terms of pay being reduced, VAT, and that provided a bit of cushion for most Kenyans. And although I advocated for more monetary policy, we saw most of the stimulus coming from the fiscal side. Now, coming into 2021, this was essentially supposed to be the year of the recovery, year of hope and the rebound that Nancy talked about earlier. And, but that's the same time that the government rolled back most of the fiscal measures. And when we came into March, the central bank was already telling people it's time to start paying back your loans. The economy is back on track. Only for 2 days later for the president to lock down the country. So it's been confusing in that sense. I'm glad there was that reopening that we saw on Saturday. But I feel there's a sense of restlessness really on the ground. You remember about 3 weeks ago when the price of fuel was about to go up, and it was only on the night of the price change that State House changed its positioning, and it said let the oil marketers absorb those extra costs and they'll be refunded a bit later on. Apparently that was because of NIS reports that sort of stated that there's a lot of restlessness on the ground. So indeed, this was an early reopening. I think I was expecting May 28th. That's what I think the CS had said. But it tells you that a lot of people are on the edge. 2 million jobs have been lost. Businesses don't have the support they need. And it's time now to really rethink of how do we strengthen our monetary policy, particularly monetary policy. Because if you look at other countries' response to economic response, we saw, I try to break it down into 3 categories: the G7 countries, the emerging markets, and the frontier markets. If you look at the G7, the Japan, 54% of GDP in terms of stimulus. The US, 26% of GDP. When you look at the emerging markets, talk of Turkey, 11% of GDP, Argentina, 6% of GDP. Our neighbors here in Ethiopia, it's a frontier market, did about 2% of GDP. Here in Kenya, we did 0.6% of GDP. So we're in that club of less than 1% in terms of response. So I think the big thinking we have to think of, why did we do so little and what do we need to do moving forward? Because as you said, we might have more waves coming back. How do we have more aggressive stimulus measures, particularly from the central bank? Because countries that have had very robust measures have been using the central bank much more than the treasury.
So Ken, maybe just to follow up that question, what would you like to see in this particular budget from the CS to stimulate the economy?
I looked at the 26 billion shillings that has been put in. About 8.6 is liquidity to businesses. But that's a big confusion. Liquidity to businesses is monetary policy. So that should be coming from the central bank side. Treasury does not have that access in terms of, they have to use the banking sector to be able to pump in that liquidity. So it tells me that the intentions are there, that they need to prop up, but the mechanisms of monetary policy transmission are not there. So had that 8.6 billion been given to central bank to be able to be pumped into the economy, I think we would be able to see that money multiplier effect.
Thanks for those views, Ken. So I'll switch to you, Dr. Gacheri. I think Ken has teed it off very well. So Big Four agenda. So manufacturing is one of the big pillars, one of the key pillars in the Big Four agenda. And I think that's a sector that you're well versed in and that you've now switched after you made, is it a career change? Which is a fantastic career change from being a medic to manufacturing. And you're doing well, and that's good. So maybe just take us through what the manufacturing sector has been through in the last 1 year of this pandemic. I think we're just over a year now. And whether you feel the government has done enough. There's some of the stimulus measures Ken has alluded to. There have been others from April last year to date. What has been done so far, and what would you like to see geared towards stimulating the manufacturing sector? Because before COVID, the pillar had already been identified as one of the routes to growth for the economy. 70% of our economy is based on SMEs that are trying to get into that sector to manufacture, from cottage industries to what have you. So take us through your views on what we have seen so far. Is it adequate, and what would you like to see?
Thank you. So for the manufacturing side, and in terms of the economic stimulus that we did see, a good gesture from the government, indeed. But was it enough? No, it wasn't. Looking at manufacturing, I think we were caught flat-footed. We have been talking about ensuring that we industrialize the country. Unfortunately, it's not been achieved, and there has not been enough effort into industrializing the country. Actually, we are industrializing the country because we've been stuck at a 10% for such a long time. The last time we had something close to what we are looking at is 2017, when we had an 0.4%. By this time, we are actually just going back, and the COVID-19 pandemic didn't make it easier, because we actually ended up with contraction in the manufacturing sector. So when we started the year in 2020, the first quarter, we actually experienced a growth of about 2.9%. Going into the second quarter, when we went into a lockdown, we were operating at 3.9, a negative 3.9% as a contraction. Quarter three, because of the stimulus, and I believe a bit of, there was disposable income out of the stimulus into the economy, we experienced a bit of a rise, and we got a contraction of 3.2, obviously a slight improvement from the second quarter. And to be very honest, I think manufacturing is still suffering quite a big deal. We have spoken about it many times said how this country cannot be able to go forward unless we're actually able to industrialize it. And there are no economies in the world that have made it without industrializing. If you look at what is calling emerging and the ones that have already done it, they've actually done it through industrialization. Here we seem to be working backwards in terms of industrializing, and obviously it has its own effects. And when we look at the pandemic, look at the Big Four agenda, the 3 others actually are dependent on manufacturing. And you did realize how much of an effort the manufacturing sector had to make in what we kept calling Keep Kenya Moving. Because if we went into making PPEs, if we went into ensuring that the economy was running, there was food, we were ensuring that people were I could see people actually having no houses in the middle of the pandemic and being thrown out, and all that was happening. You still need the manufacturing sector to be able to get there. So if you ask me from where I'm seated, we were caught flat-footed, because if we had done what was necessary for the manufacturing sector from the word go, we should have been caught in a better position. If you realize, our country has been a lot on services as an industry more than manufacturing. When we got into this pandemic, the services industry actually contracted at a greater rate than the manufacturing sector, which is more resilient and which would have kept our economy looking better had we done it previously. Because this is not a conversation that was started yesterday. It's a conversation we've been talking about in the Vision 2030. We are talking about it now in the Big Four agenda. And truly, we're actually seeing action now when we are left with 1 year of operations within the Big Four agenda. So I'm not sure what we can achieve in the 1 year that is left that we've not achieved in the previous 4 years. But let's see. I am honestly not very hopeful, especially when I look at the budget statement that was released. And when you look at the allocation into the Big Four agenda, which is 135 billion, you have 54 billion going to food and security, you have 47 going into health, and a paltry 18 to manufacturing. So I'm not sure exactly what we are looking at and what we are expecting to get out of manufacturing by putting in so little. The other thing is we also didn't cushion and protect the industry, especially because our industry, as much as it is operating, we have a lot of inputs when it comes to input. And so because obviously there were supply chain interruptions, we ended up with a lot of problems, because you realize a lot of the inputs that we use actually are taxed at the same rate as finished products. So when you bring them at that rate into the country, obviously you're just saying our competitiveness against the rest of the manufacturing countries around and wherever else we are trading, it's actually almost impossible to be able to be competitive. So you realize we ended up with a lot of businesses closing because the margins within which they operate are very minimal. And so therefore, trying to ensure that you survive within an economy that the inputs now were higher because getting things in was becoming more difficult and more expensive. It's the reason we are seeing the results we are seeing in the manufacturing sector at the moment. So yeah, that's where we are.
All right, thank you for those views, Dr. Gacheri. And do you feel the government is listening to you manufacturers enough?
Well, you know, the way to know that the government is listening is by the response. The response is an 18 billion, which I am not very sure is actually pointing towards listening. When we look at what the government will be doing in terms of policy and regulations, it's actually we give and we take away. So for example, we had the stimulus, but at the same time, when we look at our regulatory framework, for example, last year, while we were running the stimulus, at the same time, we were also looking at a situation where KEBS, which is a big regulatory body in the manufacturing sector, for the first time and onwards, actually decided we were going to pay for standardization for 2 years going. I don't know how many SMEs, you have mentioned that this country has 70% SMEs. I don't know how many SMEs are able to run on a budget of 2 years. For example, when you look at the suggestions that we are seeing, minimal tax, digital tax, I am not sure how many businesses are going to survive that, and I'm glad that we have the suspension on minimum tax, but I'm really hoping that in future we scrap it all together, because then we are not helping businesses by giving them on the one hand and then taking away on the other hand.
Thank you for those views, Dr. Gacheri. I'll come back to some of your panelists on some of these issues. Now, over to the far end, our tax guru, Francis, and maybe just to getting into this topic around tax, maybe some views from you around what we've seen since April last year with respect to some tax reliefs being extended, and then they were rolled back a few months ago. And your view there around, was that counterproductive? Was it actually helpful for the 9 months that we ran those relief measures around tax geared towards certain sectors, etc.? Did it achieve much? Some of it was geared towards the sector that Dr. Gacheri was just taking us through, manufacturing and a few other sectors. Your views around whether the government actually was achieving much with those tax reliefs, which they then rolled back and removed around January.
Thank you very much, Robert. And it's quite difficult to talk after a medical doctor has put the case very well for manufacturers. So I hope I'll put the case for tax payers quite well. But having said that, the previous panelists have talked about areas government is not doing a lot, and maybe I also hang on the same, because what the government did initially is to bring a stimulus around the whole aspect of giving us a corporate tax rate from 30 to 25, very good. I think it's not bad. And they went again for tax brackets from the highest 25, from the highest 30 to 25. And again, VAT from 16 to 14. And it also did something, after all those niceties, it hit manufacturers on capital deduction. It completely killed them in terms of reduction. Some of them from 150 to 100. So that's where we are. That was April 2020. 1st January 2021, according to the government planners, there was no COVID. Everything was hunko-dory. So they changed the whole thing altogether, that the incentives which were put in place, all of them were reversed, the original situation, except that they don't reverse for manufacturers in terms of capital deduction. When I say manufacturers, they also touch on other sectors, so to speak. So having said that, that was not right. And we are thinking the whole aspect was government to do more, Robert. And one of them was give a tax holiday to affected sectors. Whether the government thinks it's going to lose, it's not going to get money. It will just see, guys getting innovative. For example, are you going to collect any tax in hospitality industry? Are you really going to collect money from those buses which are moving, for some of us who have stayed in Western Kenya, Nyamira Express? Does not move these days. It's still somewhere, Eldoret Express, or Mobile Success, all those. I mean, are they moving during the lockdown? So just give them tax holidays, so to speak. The other particular issue is if I donate today, as a Dr. Wala, as Ken Gishinga, if I donate, is that a tax allowable? We need a law to cover those donations. So again, we cover our people. So when we have our own Aga Khan University head here, and they decide they are going to go to the streets and give masks, of 1 million, is it allowable for tax? Nobody has come out very clearly about communicating that. And once somebody said, the worst part of communication is thinking that that communication has taken place. Government has done very little to communicate around COVID. The other one is subsidies. I know for Ken Gishinga and co, they don't like these terms of subsidies, especially the economists, being part of that particular team. But let me tell you, economists, some of these things we have to subsidize, especially food. To some, I mean, you saw in 1924 Al Capone giving soup. During that particular time, Europe and America were in hell. And that was a thief who was actually giving soup in the street, so to speak. Subsidies can help in this particular economy to assist certain affected team. The other one is capital expenditure reduction. This is a bit funny, but please build roads, rail, but we are not going to use roads when we are dead, Dr. Wala. Roads and railways are used on population that is alive. Many countries have cut the capital expenditure. To conclude, two things. Health sector, in terms of where I'm looking from allocation perspective, please just hope for a Brazil, hope for an Israel kind of scenario, but plan for a Brazil and India. Plan for the worst. That's what I was taught in my economic class. We need to plan, and planning that, many countries have seen them doubling their allocation for health. Somebody will be telling you how much has been allocated, which is a far cry. Lastly is to basically ensure that from a tax perspective, let's communicate the right information, especially when it comes to the issue of corruption. When we basically have a KEMSA deal on COVID that has gone haywire, which tax person is going to put a coin or will be willing to put an extra coin in terms of donations, in terms of subsidies? It all goes wrong. So government has a lot to do, and I'm just touching part of it. The panelists will add to the rest. Thank you.
Thank you for those views, Francis. And I'll come back to you, Dr. Awiti. Much has been spoken about on the Big Four agenda, even before the pandemic. And the Big Four agenda, as far as I know, is still there, front and center of the Jubilee's manifesto and thinking in terms of how they can get this economy to middle income economy, sustainable growth, etc. And I'd like to just get some of your views and your thoughts around what you'd like to see the CS allocate in terms of this budget, bearing in mind what has been spoken about here around the pandemic, some of the priority areas touched on by some of the other panelists, etc., and your own views around what you'd like to see in terms of allocations around the Big Four. So first of all, are you of the view that the Big Four agenda, is actually the way to go? And number two, what would you like to see in terms of allocations from the CS towards that agenda to get our economy going?
I think in terms of kind of emblematic policy anchorage, the Big Four is a very seductive proposition. And if you look at the four components in the Big Four, manufacturing, affordable health, housing, and food, I don't think there's any economy that would survive or be viable or be credible in the eyes of a voting population in a democracy such as ours if these things were not met. I think, to Dr. Waller's point, the deindustrialization effort, deliberate deindustrialization effort by our government, because of the paltry spending policies, is just shocking. And it looks like we've learned nothing from the supply chain disruptions across the world that basically has paralyzed a lot of our industrial manufacturing effort. I would have expected the government to throw everything at creating Make in Kenya, Buy Kenya, Make in Kenya. And I think the set of incentives around that have been endured, the set of disincentives around that have been enduring across governments, from Jomo Kenyatta. The African deindustrialization process started in the 70s. And as you understand, the contribution of industries to GDP has been absolutely stagnant. Despite Kibaki's own pontifications, Moi governed in a very different regime, but we've become a warehouse economy for all intents and purposes. If you look at everything else, it is wired towards a kind of an import economy where we just bring in stuff. So everything from that incentive structure, from energy to credit to infrastructure to even building a workforce that can support an industrialization process has been very difficult. Middle-level colleges, basically comatose. What we're trying to do now is massification of TVET. And again, it is just going to fail because it has to be targeted and it has to really model itself around the structure of an economy that we see going forward. If you look at the inordinate kind of proportion of the service sector to just basically government revenues, you can easily understand why they're stuck there. Because it is the easy, low-hanging fruit at the expense of really rigging deep into the economy, the plumbing structure that then builds a stable, robust economy. And to a point, the sectors that have been resilient and basically are kind of buoying our potential to recover is manufacturing. Wholesale, retail, hospitality, dead. So that's one part. So I just don't understand what Mr. Ukur Yatani and President Kenyatta are thinking as we speak now. Health is another one. Yes, Israel is a model in terms of vaccination rates. As we speak today, only 1.6 per 100 of the population in Kenya have been vaccinated. We were discussing this at the breakfast, that even by 2023, just 30% will have been vaccinated. So to be just kind of morbid, I tend to suspect that the government thinks they will be infected into herd immunity. That people just fall sick, and then the ones who have to die will have to die, and then somehow we'll just evolve into a herd immunity epoch that is just driven by disease, mortality, and morbidity. It is macabre for us to even imagine what the government is thinking about this path to herd immunity. There's all kinds of scattershots in the budget statement about herd immunity. It is a great aspiration, but we've got to roll up our sleeves and figure out how to get vaccines in the arms of Kenyans. Otherwise, we will be switching on and off the pandemic, and these lockdown measures hurt the economy deeply, and to recover from them takes heart, which I don't see in our government today. Now, the other part is the food sector. Nutrition is critical, and Dr. Awala will tell you that path of recovery from COVID is predicated on access to not just food security, but nutrition security. We've seen how this thing ravages people who are just malnourished, even though they look very healthy. They just don't survive. So I don't understand what part of this equation and what part of the significant contribution Big Four can make to the recovery process Mr. Ukur Yatani doesn't understand. You know, to distribute all these elements into various sectoral budgets, to me, is just nonsense. You need a full-throated, big budget, even if it's deficit. I don't think that if that deficit is investment into the future, that it will hurt this economy. Even if that borrowing into the future, there's no country that will shy away from debt. But the question is that, is it productive debt? That's what we have to ask ourselves. Uhuru has basically sold us on the Big Four agenda, but he has failed to put the requisite capital and policy infrastructure and fiscal policies and budget resources behind the Big Four. Now, my worry is that in a transition period such as where we are now, I see some of the major players in the next political dispensation, like Ruto and Mudavadi, very lukewarm about the Big Four. We drop the ball, the recovery is going to be extremely difficult in 2023. We will never recover if there is a gap in terms of policy commitment to get out of this rut. So that's what I worry about, and I think the Big Four is front and center. But if the next government is going to pay the kind of lip service Uhuru paid to Vision 2030, then we're in deep trouble.
Okay, so, but maybe just in summary, what would you like to see the CS do in this particular budget?
I think the CS, you know, part of what is frustrating is that we're now in a budget cycle. There'll be a lot of other extra budgetary allocations in terms of stimulus, which is just nonsense, because when it's just kind of catch up. But I want to see a credible, full-throated policy and budget resources around these critical elements in exactly the same way that Gachagua has described, to really pay our dues to resuscitate industrialization, to bring in the resources to move us to the Israeli kind of herd immunity vaccination rates. Now, these two things are absolutely critical going forward. And then food security, of course, the agriculture our productivity, cash productivity is also as static as industrialization. Growth of 3% over several years as a steady state is just really laughable.
Okay. All right, thank you for those views, Dr. Awiti. So I'll come to you, Dr. Gachari. Maybe just a question that's tied to this. And maybe for this, in this particular budget, what would you like to see the CS do to ensure, so I think we've all agreed that manufacturing is such a critical sector to get right, and you yourself mentioned that you cannot industrialize an economy without getting manufacturing right. I think for a long time our manufacturing has been below 7% of GDP, and I don't know what number it is now. Maybe you have the accurate numbers, you'll tell us. But a very low number, and we need to get it into the teens to really talk about industrializing our economy and getting jobs for our youth and the right kind of manufacturing focus. So what would you like to see? And do you feel in this particular budget addressed by the CS to ensure that we not only stimulate manufacturing right now to get us out of the kind of quagmire we're in with the pandemic, but also ensure continuity? And remember, manufacturing was also envisaged as one of the key pillars in Vision 2030, which now seems like a long time ago. But actually, whichever way you look at it, it did touch on some of the right pillars that even successive governments, if they're not playing politics with what was thought about then, should actually be looking at many of those pillars till now. So what would you like to see the CS address to get manufacturing up and running, being an insider?
I think I did mention earlier on that the first thing that we are missing out on is competitiveness and protection of the sector. When we look at what the government is doing, and I have seen a lot of efforts into getting us markets out there, both internationally at the global level and at the regional level. But when you look at when we trade in those markets, then what? Are we the ones doing the exports, or we are being imported to? Because you could get a market, but then it becomes a large market for the other forces on the other side to be able to trade and not for you to be able to trade, really. So what I would actually be looking at is, are we incentivizing manufacturing in a way that, especially the inputs, is the biggest problem? Because let's face it, we have not done enough in the past. And so we are not able to get the inputs from locally. For example, one of the places that is really giving us problems right now, the health sector, if you look at the pharmaceutical area, 95% of the inputs are actually imported. So can we be able to ensure that at least we have less taxation on the inputs for manufacturing, and so that when we get into the other markets, and all these markets that we are looking at, the UK, now we have the African Free Trade Area, can we actually be able to be competitive? Because I was looking at how our neighbors are doing in terms of manufacturing, and to be honest, countries like Ethiopia, Rwanda, Tanzania are actually ahead of us in terms of the rate at which manufacturing is developing, and we were ahead a few years back. So it means in the next few years, the truth is, unless something drastic is done, then we'll actually be trailing, and doesn't put us in a very good map as it is. So if we would have competitiveness at the level of, can we reduce and not just the inputs, also energy is a big problem in manufacturing in this country. We've seen monopolization by KPLC, and there's very little effort in all these other forms of green energy to be able to assist with what we have. Very little is going on, really, when it comes to energy, and it's been a conversation that's been talked about for a long time. So while we are looking at the markets, and I see there's been the mention of financing SMEs, but how are we doing it? I have seen at least the government come on the table with Kenya Association of Manufacturers to be able to see whether they can support SMEs in manufacturing. But I am wondering, when we do that, but on the other hand, for example, the other day, Kenya Bureau of Standards was looking at how they look at regulations and standardizations in this country with some of the manufacturers. And when you look at our framework, really it's one of the hardest in the world. Because when you have to keep people, manufacturers, for such a long time before you give them a standardization, while other countries actually have a self-regulatory way of doing things, then you are actually killing innovation. Because, for example, if we, and the kind of population we have in this country is extremely innovative. We've seen ideas in this country that if they were supported, you would be very far. So if you ask me, we need to look at all those things in terms of what can we do to make our industry more competitive in the market, as much as we are getting the markets. Yes, it's a great thing, but you can't do one thing and not do the other and expect to move forward. You just keep going around in the same area. So can we create competitiveness by ensuring that we sort out the issues of energy, we sort out the issues of input. And also, you have mentioned Vision 2030 and the fact that it's almost looking like it's dead. And you know, I was just looking at the Big Four agenda, and I look at what is in the Vision 2030. We actually had the Kenya Industrial Transformation. Sorry, you can't hear me?
No, you can hear you.
Okay. Okay, great. Okay, thank you. We had in the Vision 2030 the Kenya Industrial Transformation Program. And when you look at what it was focusing on, we were focusing on agro-processing, and we were focusing on leather and footwear. Now, when we came to the Big Four agenda, we actually focusing on two very different things. We are focusing, well, the leather and footwear remains, but now we are also looking at textile and apparel. So where did we take agro-processing? So we have policies that just keep fighting with each other. So you have one that comes and counteracts the other. So I'm not sure whether we are now focusing on the three of them in the manufacture. We need policies that work. We need policies that are supported by the frameworks that we put in place.
Right, so we need a bit of consistency as well.
Yes.
All right, so I'd like to switch to, thank you very much for that, Dr. Gacheri. I'd like to switch to Dr. Wala and back to the issue of health. And health is one of the pillars in the Big Four agenda around universal health. So first of all, your views on whether that's a pipe dream. Is that something that's attainable? I see you smile. This is a global debate around whether universal health coverage is an achievable goal. You know, or is it, you know, are we basically chasing a pipe dream here? And number two, if it is indeed realistic and attainable a goal, what would you like to see the government do towards that goal of universal health coverage? And granted that it probably cannot be achieved in a day, or probably in a particular time period, what would you like to see the government do towards that goal of universal health coverage?
Thank you very much. So for the universal health coverage, first of all, to say it's a vision. And I think it's a vision not just for Kenya, but for many countries. There's no country in the world that has achieved it. So there's a progressive realization of some of the indicators or the goals within it. We look at a cube model where you're looking at more people suffering less from financial distraught based on their healthcare expenses. You're looking at more diseases being covered and using a very strong health economic background where you aim for interventions that are of a higher impact and low input kind of thing. And then the third one, you're looking at the quality of the services that are being measured. So when you talk about access to health services, it's not just physical, there is cultural, there is geographic, there is financial access. So all those three need to be considered. Now, as piggybacking on what Dr. Gacheri and Dr. Alex have said, we are perfect as a country in coming up with policies. In fact, I think the highest earners in this country are consultants, and some of us are consultants, so feel free to reach out. So we draft very nice policies and guidelines, and where we fail is implementation. I would say if you get the example of Nairobi Metropolitan Services, we had a chance to have a chat with the General Badi, and he said when he took over, he did not come up with anything new. He simply went to the plans that had been there and started implementing. So for the health sector, what we are asking for is, why don't we just start doing things the way we have planned for them? The other thing is to know that as long as something is a policy, is a document, if it's not an act of parliament, it is something that doesn't have a legacy. So the next government can come and say, you know what, this is going to be my legacy project, and throw the thing out of the, out into the cold. So we need some of these things entrenched in acts of parliament, such that it's mandatory for any government to execute them. The other one that we talk about is more health for money. So I laugh when Gesheri talks about 7% in manufacturing. In health, I don't think we've ever passed 6%. And yet health is the pillar that drives the economy of a country. We've always been seen as a consuming sector rather than a sector that's able to give our demographic dividends. So by focusing on our youth, focusing on our population that is hardworking, giving out driving the economy of this country, we need to stop seeing health as a consuming sector. The last but not least is looking at accountability. And I think if we fail to mention this, in whichever sector, but I think health, was ranking around the second in terms of the scandals that are, within it. We get to hear, yes, there's a KEMSA scandal, yes, there is a UHC scandal, there is a what. We don't see any activity towards curbing corruption with this country. We see so much money that is going through the drain because of this. Now, if only we were able to seal those loopholes without adding that 6%, I'm telling you, we'll be very far as a country. So we need to take accountability very seriously. We need to empower our citizenship to speak up. And there are many, many programs that are trying to do that, where the Wananchi are the ones now going to, their leaders and saying, look, this is what we promised, this is what is on the ground, what are you doing about it? And I like the example that was in the petrol thing. The fuel issue, it means as Kenyans we have a voice. So let's not sit helpless and say we are at the mercy of the technocrats at government. We have a voice as a citizenship. And so what we need to move away as a country is donor-driven policies, donor-driven budgets. Even this budget that's being read that's being presented to Parliament today, you know what they don't tell you is that in the health sector, over 60% or 70% of that budget is from donors. So it is either a grant or it is a loan, but it's not our own money. So how do we ensure that we start shifting away from donor-driven programs into domestic resource mobilization? We are now a middle-level country, yeah? Now, middle-level implies that, our vaccination processes, by 2022, we are no longer going to receive free vaccines. Now, I'm yet to see the transition plan for the government in terms of that. So we need to, as a country, to remember that the figures that are being presented, let's look at them keenly, because it may look a bit, positive, but most of it, including the vaccines that we're receiving, they are a donation. At some point, we are supposed to purchase for COVID-19 vaccines. So I would push a lot towards, just doing the things based on the policies. Let's not sit again and talk shows throughout, and just start implementing many of these very important policies that we've already laid in place.
And, just touching on that, Dr. Wala, do you feel the government is listening to practitioners, health practitioners like yourself who are on the private sector side, in terms of how they can actually, I like your thoughts there around not looking at health as just a consumer or, an expense, area for government, but rather something that I I'm fearing to use India because India is going through some issues at the moment. But granted, I think in the past, apart from the current issue they're going through, I think they have them alongside a few other countries are one of those that really managed to kind of get their health sector focused on a very different aspect, which is medical tourism. A lot of Kenyans go there to India for treatment. I know it sounds funny speaking about India at the moment because they're going through some issues, but I think credit, let's give credit where credit is due. India has invested significantly, but they have 1.35 billion people, and maybe that's why it wasn't enough, so much that they did. But I hope the government, and just very in summary, you feel the government is listening to policy drivers like yourself, who can give a different school of thought around how the government can reshape health in this country towards the direction that we've seen in other countries. So we start seeing people coming in for medical tourism. I know we have people from East Africa who come to Kenya to some of our leading hospitals, but probably not enough. Do you feel, in summary, government is listening to private practitioners in this issue, around these issues?
Thank you for that. So as a health sector, in the private sector, we are organized into faith-based institutions, so whether from the Catholic Church or from the Protestants. And then we also have the proper private sector, which is Kenya Healthcare Federation, which comprises of quite a number of players in the health sector. Now, we've had an opportunity in this government and the past, but this government particularly, in terms of having platforms where we interact directly with the technocrats at government, but also have a voice with the cabinet secretary. We also have platforms where we plug into the Kenya Private Sector Alliance, where we are the health sector board, in terms of presidential roundtables. I would say much of the advocacy work that goes behind the scenes is bearing fruits. In fact, many of these stimulus packages that we saw last year were the very hard efforts of the Kenya Private Sector Alliance, amongst other players. But there is more. I would say we are moving towards recognizing that private sector do have a role. In fact, in this area, there's no one who's talking about the health sector that has been affected both by the disease itself, because we do have our facilities overstretched, but also as businesses. I have very many colleagues, very many SMEs, people who had just started health centers, health facilities, radiology units. People started avoiding going to hospital. So we have the business members within the health sector who are going through the same issues that other business members are doing. So I'd say, yes, there is a positive light, but then, as Dr. Gasheri mentioned, the proof is in the pudding, which is in what happens at the end of the day in terms of the budgetary allocation towards health.
Okay, thank you very much, Dr. Wala. And maybe just as we look to wrap up this exciting conversation, I want to go back to our tax guru, Francis, at the end there, around this particular budget. It's an expansionist budget again, 3.6 billion, I believe, thereabouts, and trillion. Sorry, did I say billion? Trillion. Thank you, Dr. Witi. Yeah, so 3.6 trillion, and just your views there, and around whether you think this is attainable, or are we back to exactly where we are every year? Sorry to sound skeptic, but I think you and I have sat a couple of times. But just your views, let me know, bias, what you're going to say about what you think about the budget in terms of 3.6 trillion, and we'll come back to how that's financed in terms of 2 trillion being financed through on revenue and appropriations in aid, etc., and the balance through debt and debt rollover. And we'll come back to that with Ken on some views on that. So just your views around the budget. 3.6 trillion, again, is it attainable? Is it in the right direction? Where are we headed?
Thank you. And one of the areas which maybe I'll take more time is looking out of 3.6. How much do we want to raise in terms of ordinary revenue, which is 2 trillion? 3.6 trillion, we raise about 2. So again, we need to ask ourselves those questions. Number one, they are not going to meet it, and I'll give reasons and the measures they need to take in a nutshell because of time. So the first one is because of COVID. COVID, I'll just basically mention 2 things. One, millions of jobs have been lost, so PAYE must reduce, whether you like it or not. Number 2, Most companies are making losses. So corporation tax, down. They tried the process of minimum tax that even loss-making companies can pay tax. Number one, Adam Smith said that you basically have to collect tax on economic rent. You can't, even if you force somebody to pay tax. For example, I give an example of companies like KQ. Even if you beat them and you hang them on a wire, they're not going to produce money. They have no money because they are making losses because tax is basically collected on economic rent. Number two is expansion of the tax bracket. We only 3.5 of us, myself and Gasheri, who are paying tax, out of 20 million voters. Yeah. So, and of course now the other I can see they look as if they are paying tax if you look at their faces. So having said that, these very, very few people who are paying taxes, 3.5 million, so they need to expand the bracket to at least 9 million Kenyans. The other one is government support to KRA. You can't basically talk about KRA without talking about the government needs to support KRA. I'll just mention one of them because of time. One of them is e-government. Ensure this particular person, who when he is making, when Dr. Alex is selling that land, 200 acres in Webuye, he's selling that land, he is able to be caught by his county and he pays tax in Nairobi. So e-government, is KRA going to see that Dr. Alex is doing that transaction? So that's very important for KRA to be able to catch. I'm not saying, I'm giving an example. The other one is registration. The current registration we have was promulgated in 1963. As you can see, at my age, I was not born. I'm not saying I'm young either, but that is a very old paper. It's a tome, very old actually. The other particular part is national tax policy. Up to now, to shock Dr. Alex, to shock Gishinga, and the rest of the team, we don't have a national tax policy. We just did one in Rwanda called National Accounting Plan about 10 years ago. Kenya, we don't have, but what we basically say, hakuna matata. The other particular point which you need to mention is refunds. Can you allow, I mean, you have my money and you're not giving my money, tax refunds. I don't elaborate on that. KRA needs to be supported by national government. Just 2 points or 3, because of time, is governments need to drive the economy. And I think manufacturers have talked, health practitioners have talked, so that you look for labor intensive. You employ these young people. Of course, I'm not against tourism, but you remember agriculture and agro-processing and manufacturing are labor intensive is going to absorb this idle labor which is disturbing us and start contributing to the national coffers. KRA administration, just give an example. Yesterday I was dealing with a case of a tax person who has a case of 1993 of tax refund. They have never been reconciled. Some people have retired. I came, I took over the case. 1993, it has not been reconciled. So its efficiencies and inefficiencies need to be dealt with. The other one is the national cycle to pay tax. There is no national cycle to pay tax because of graft, because sometimes Francis Kamau is here, he has overpaid. I can even make an error to pay tax. I make an error, and KRA cannot refund that money within 6 months or never refund, and it's an error to pay tax. Lastly, for me, because of time, is taxpayer education to everybody, including my daughter. Somebody was saying, when you are giving her the donuts, just eat 3 so that at least she feels the pinch of tax, then she only eats 7. So we need to educate these kids about paying tax. Thank you very much.
Thank you, Francis. So maybe before I let you go on that,
yes.
So are we saying the government, instead of looking expansionist at 3.6 trillion, should be looking more realistically and saying where we as an economy, what's achievable, what's sustainable, what can we fund through our own revenues, et cetera, and be realistic around that? Because I think every year we're in the same situation. We talk about, a really big budget, how we're going to finance it, we're going to finance the rest, and none of the, both on the revenue and the expenditure lines, none of them are achieved. So what's your advice to government? Should they step back, be more realistic, where we're not going to attain 3.6, and neither are we going to attain the 2 trillion that we're seeking to achieve through, own revenues, tax revenues. What's your advice?
My advice is very simple. Just be realistic. just barely risk, because what will happen is that you've told Kenya Revenue Authority to collect 2 trillion. Number one, what they'll do, they'll go, and actually they make laws, by the way. They sit at the Treasury, and whenever we go for the Institute from 2007 up to now, they're on the other side, making laws so that they actually, through the budgetary process, so that they actually implement them. One of them is what I was talking about, minimum tax. They'll participate in creating rules and regulations that even laws-making companies will be paying taxes. I mean, so they'll really overstretch the system. The other one is using bodies like DCI to collect tax. I mean, somebody said that IRS is the age of death, if you have watched that movie. We should not be allowed to be seeing that particular platform of having an age of death to collect taxes because of the national psyche. And all that should be enshrined in the national tax policy so that it makes sense. The other one is some taxes which basically Grace was mentioning here. Robin Hood taxes. Yeah? So I steal so that I benefit the poor. So, I mean, that is the analogy it's given. And you might see it reverting back because we are not realistic. If we tell Kenya Revenue Authority, based on what we have done and the system that we have put in place, please give us 1.4 trillion. They're not going to overstretch themselves, overthink, and of course collect taxes which was not supposed to be collected using the current registration. Thank you.
Yeah, thank you, Francis. I think that sounds realistic because every year we are having the same discussions. We don't hit any of the numbers, both on the expenditure. So thank you, Francis. And to sum it up, we'll come back to my good friend, Ken. Ken, the other topic that's tied to what Francis has just elucidated on is the issue of debt. So about $1 trillion of that budget we've just spoken about is to be financed through debt and debt rollover. And I think maybe just give us your views around whether you think, number one, that's a sustainable way to go, and number two, the current debt levels we have. There are lots of, everybody's become a pundit on debt right now. Some people are on the mark, some people are off the mark. Give us your views on whether you think our current debt level is sustainable or not sustainable, and how much headroom do we have before we hit the unsustainable levels of debt, if indeed we are not there yet. Ken?
That's a great question. If you look at the budget proposal, they're talking of 60% of the tax revenue will be going towards servicing debt. That's a very high number. If you look at the IMF, the World Bank recommendations is that not more than 40% really of your GDP should be going into debt. So already tells you we are already way 20% above the recommended levels. And it worries me because if we continue in this direction, it means we'll have to take away money that could have gone to healthcare, could have gone to education, to be able to fund our debt agenda. I always say you really cannot borrow your way into prosperity. And indeed, there are people who look at Japan and the US and they say these countries have a lot of debt. But if you look at those countries also, they borrow in their own currency. And like here in Kenya, where we have a lot of foreign debt, indeed, half of our debt is foreign debt. And even a slight movement on the exchange rate is able to increase the debt levels. So I think it goes back to our idea, because if the question is, if you don't have debt, what is the other way? And it has to come back to taxation, proper, effective taxation. And I like what Francis has said about a new national tax policy. And for me, if CS Siatani can come and talk about growing the economy and building on the 4 factors of production. There are only 4 factors of production in economics. You have land, you have labor, capital, and enterprise. Those are the 4 legs of a table that make the table stable. I think for far too long, we've depressed enterprise, that last one, and we've really, really loaded all the tax. So you end up having a table where one leg is short because it's been weighed down. So I think we need a sense of balance in terms of all the other sectors playing their fair share. A lot of people look at the 3.6 trillion and they say it's a very bloated budget, but I just did the back of the envelope calculations, and if you say 3.6 trillion in an economy of about 50 million people, it brings you about to a per capita allocation of about 65,000 shillings per person. Now ask yourself, even if somebody is on a minimum wage of 10,000 shillings, that allocation is not enough to take him for more than 6-7 months. So I've never been really worried about the revenue side, the expenditure side, because we are a growing economy and we do have to build schools and we do have to build hospitals. I worry a lot about our lack of a clear tax policy, where one segment is paying so much and the other segments are really not paying their fair share. So if he can organize a budget in the sense that everybody needs to pay their fair share, I think we'd hit these numbers very, very quickly.
And as you sum up those I think very good views, when do you think we will start to hit unsustainable debt levels? Are we there yet? Do we have some headroom? There are lots of views around this, that some people feel we are way over, others feel we still have some headroom there before we hit that. And I think some of them are born out of inconsistent comparatives with very mature economies, like you've just mentioned, Japan, the US, 200% of GDP. We're a very young economy, and kind of our structure of the economy is quite different from those developed economies. Your views on, are we there at unsustainable, or do we still have headroom? Because government is talking month on month about borrowing additional. I think right now they're busy getting an advisor around a new Eurobond and a few other green bonds being considered, et cetera, et cetera. So infrastructure bonds. So are we there? Are we at an unsustainable level, or do we have headroom? And what's your advice to government on that?
That question comes up quite a lot, and it has two layers to it. The first layer is understanding that public debt has the first right on the exchequer. So whatever KRA collects, before any amount is released to education, to healthcare, the issues of public debt have to be sorted out. So when IMF look at that, they say, by all means, we do have headroom, as long as that clause that anything KRA collects, the first point of issue is the debtors, the creditors. So from that perspective, they'd say, yes, we can do more Eurobonds. But from a Kenyan perspective, you're going to ask yourself, if the government starts transferring money from social spending, if the government starts delaying money to suppliers, if the government starts increasing the tax rates, you see this 1% tax rate that the Kitengela bar owners went to dispute in court. So he told you from a Kenyan perspective, it's not very sustainable. So on paper, somebody can say yes, because KRA will always collect enough money to be able to service, but at what cost? And I think the big cost is we are going to see very heavy taxation. We're going to see very aggressive, as Francis said, where DCI actually becomes the face of collection. And that's not the direction we want to go as a country. So we do have some headroom theoretically, but from a social perspective, it's going to put us in a very difficult position.
So the opportunity cost is quite large. And I think that's a good place to close this very exciting conversation. And I hope, especially with the last 2 points raised and various other views very well and eloquently brought out by our various panelists, government is listening. And we hope that they will take on some of these views on board. I think we've touched on most of the other sectors. I think at this point, we'd like to see whether questions have come through from the audience that's listening to us online. And we can channel those. I can see a few questions that have come through, and we'll try and see how to channel those to various panelists. So I don't know whether we're at the very top. So that's okay. So there's one here around I think this is around the audience member asks, hi, should the KRA lose the case in respect of conservatory orders to halt its implementation of the minimum tax? Would taxpayers be eligible for refunds on the amounts paid? I think that's a question that's best suited for you, our tax guru, Mr. Francis. You want to take that?
Thank you very much. And the conservatory orders were issued, and what we are going to look at is that one of the things that happened was that it was a day before the deadline of paying installment tax. It was around 19th of April. So some people had already paid taxes on that. And what we are looking for is a ruling which is going to be heard according to the expert in that area before the second installment, 20th of June. So that's what we are looking for. So assume 20th of June, the court basically repeals, I don't know whether they have the power, this law by 20th of June. Of course, anybody who had paid that tax in error would basically be eligible for a refund. Now, that is on, that is on paper. Let's go to the practical part of it. It might take years for you to get that. KRA might ask you to offset against other taxes. So those are some of the things we are looking forward to, so that at the end of the day, then we manage to look at a situation whereby those refunds can be made if the judge makes the ruling that, for example, the whole thing about minimum tax is unconstitutional, or whatever reason he gives, then that one can be a situation where you can be allowed to get the refund on tax which are paid. And as moderator gets ready to pick other questions, I just need to mention that from where we are seated as the EY, we have asked for the repeal of this particular law. We have actually engaged the parliament through a letter which was signed by myself, because we still think this law does not fit in our economy. But looking at other countries on minimum tax, which have done the same, you actually in 2017, President Trump went ahead to repeal their own minimum tax. Whatever he called it at that particular time, I cannot repeat because it was not a very good language which he used. But I would use the same language he used in my mind without shouting, because I still believe this law does not fit in our economy. Two things now, as Chris gets to the seat, is that the countries which basically have minimum tax, examples are Tunisia, we also have Mozambique, and we have Tanzania and Nigeria. I don't think those are model countries from tax perspective that we should be copying. We should be thinking about Mauritius. We should be thinking about countries like Singapore, which have progressive tax laws to fuel the economy to the next level. Back to you, Chris. Thank you.
Thank you very, very much, Francis. In any event, if I could add on to what you've said, if we have a minimum tax that seeks to tax entrepreneurs from the first year, then what would we be, telling the economy? I mean, if we just take one project, which is the SGR, which really hasn't, broken even. If that were a private enterprise, that would be required to pay minimum tax. Would that really be fair? So we have one more question. We have a question: what is the current implication of offsetting tax credits in Kenya? We have Rachel Moiro.
Thank you for that question. And the way I understand it is, here we are talking about income tax credits. So the current law allows a taxpayer who has overpaid taxes to make an application for refund, and the commissioner will refund it, of course, after doing the necessary checks on that refund. Just to set this into context, we know under the income tax law, we had a provision that allowed a taxpayer to make an application if they had overpaid taxes, but now that is already repealed. But what was happening at that time, we had an expectation or a practice that allowed a taxpayer to quickly offset his overpaid tax from one year to the next. And that was a a general consensus and a practice that was accepted by the Revenue Authority. So the question we should be asking ourselves now is, did that create a legitimate expectation that it would continue? Because that is basically the issue at the moment. We now have a system that does not allow that practice to continue. Because iTax, as it is, does not allow a taxpayer to move one credit from 1 year to the next. So in the current situation, a taxpayer has still to engage the Revenue Authority to be allowed to carry forward that tax credit from 1 year to the next. So really what has changed is the practice, but not the legal provisions around tax overpayments. Thank you.
Thank you very much, Rachel. Maybe if you compare that maybe with other countries, South Africa, any tax overpayments are refunded within 1 month. So in the next month, you get your refund. So, so in Kenya, you know, although we have a sweet provision that gives interest, as Francis would say, on any refunds, we don't appear to actually enforce or have a clear timing on when an overpayment should be refunded. So then that, of course, leaves you know, businessmen without working capital that they would otherwise be using in their businesses. We have a third question on proposed changes to the education sector. This seems to have two facets. We have an economic side and a tax side. So if I could allow Dr. Awiti and possibly Ken to say what do you think would be the proposed changes to the education sector? I think it's one of the badly beaten.
I think you know, in many senses, what COVID has done to the economy is exactly what it did to our bodies. So it basically exposed underlying conditions and underlying fragilities and deferred investments in all kinds of areas, including education. So the first thing I would say is that from the very, very first instance, there is very little equity in our education system. If you look at the far-flung parts of the country, the ages of from northeastern Kenya to the coast, and then you go to northern Kenya. At the same time, if you look at the last population census, that's where you have the highest numbers of household members. So that's the growing part of the country. And yet, access to education has been dismal. And the fact that we have had COVID and moved education online, in some sense, they've been severely disadvantaged in many respects. So I think the larger conversation is really around the fundamental reform in education and the governance in the education sector. I think it is very difficult for a distant bureaucrat sitting in Nairobi to determine exactly what a child in Tana River district should learn. And I think this whole fixation and obsession with the national curriculum is just ridiculous in many senses. It is not in keeping with best practice across the world. This is one of those very annoying legacies of our colonial hang-ups that we've just refused to think. You cannot examine a child who is educated in Nairobi using the same syllabus as you examine a child in Turkana. Education is really around efficacy and around building the capacity of an individual to be effective in the economy. I'm a child born in Turkana. I see my parents raising livestock. It's a livestock economy. How am I ever going to support and sustain that economy when you're educating me out of Turkana, and then when I come to Nairobi, I can't find a job? So that's one part. The basic education, we've been toying around with curriculum in terms of the arrangement of the education process from 844 to from 763, from what we had last time was 7 years in primary school, 6 years in secondary school, 3 years in university. Now we've gone to the new competency-based education that is like 3 and 6 and etc. And I think the fundamental question is really that arrangement in terms of the delivery structure of the curriculum is not really the problem. The problem is really the content and engagement of the child. The education has to be child-centered. The education has to be adhered and fed and responsive to the economy and to the context of the child. So all of these things that we keep doing with distant capital bureaucrats that don't even involve teachers. So I think one of the most disconcerting things is that in this discussion around the curriculum, teachers are not involved. There are people who sit, and I respect my friends at KICD very, very much. I respect the consultants that put the competency-based education curriculum framework together, but there was zero input from teachers who actually will teach this curriculum. So I think we are buffeted by two things. One is a pandemic, and then the teething problems of activating the CBC. The other part of the education system is just not really a system. There is the TVET as well that is disconnected from everything else, and there's lack of continuity. How do I start my education? I break in class 6, I do something, trade test, I go to a TVET, I get my diploma, get my other qualifications, and I come back to the mainstream, and I go to university as well. So this is what the CBC tries to do, but I don't think we have the resources again, because it's also a very expensive and intensive curriculum. So I think it's, it could be a conversation for a whole day, but I think we need to step back and really reimagine the education in the image of the child. See the education sector, the education curriculum we're offering through the eyes and the lens of a child and the teacher who will be sitting in the classroom.
Thank you very much, Dr. Ken, within the value chain of education, what do you think?
Indeed. One of the things that we do at Mentoria is we look at cash in circulation in the economy. And one of the things that we noticed in January when schools reopened, we saw a lot more activity picking up, because when you reopen the schools, there are all these auxiliary services that come up. The school driver, the food producer who's selling to the school. So it's actually, I came to realize that it's our anchor sector in the economy. And if you look at our human capital, it's our competitive advantage. One of the things we have above Tanzania and Uganda and DRC, all these countries have natural resources, but what Kenya has is the human capital. It's the auditor, the lawyer, the engineer. And even if you look at our diaspora remittances, last year we were able to clock $3 billion worth of diaspora remittances. So these are Kenyans who have been educated in Kenya, and they are working in London, in Johannesburg, in Perth, in Kampala, and sending money to Kenya. In fact, diaspora remittances has become the largest source of foreign exchange, way beyond tea and coffee and cut flowers. So it tells you the human capital, and the way you develop a human capital is through education and, of course, healthcare. So for me, a bigger spending in terms of education can have huge ripple effects across the economy. But even the healthcare part, it's critical, because if you look at the top 10 killers in Kenya, 9 of them out of 10 are health-related. So really, we need to go back, and that's why I said our debt-driven economy can be very dangerous for this economy, because it means we'll have to take out money that could have gone to healthcare and education. So education is a critical part of the human capital, and I think we need to look at countries such as India, where you have a huge diaspora, educated in India, but really driving corporate America today.
Thank you very much, Ken. And I think we will, in the interest of time, possibly come back to that. You will possibly tell us, how that education leads on to the IP in Kenya, and we can, how we can commercialize that and have that, in Kenya. But we do have our education sector tax experts. I think we have Anne, who should be joining online to give us. Thank you, Anne. You can tell us.
The issue of allocation from the exchequer is okay, because we know free primary and free secondary education. But I think the question is more about what are we doing about the private sector, who are also playing a key role in supporting government in providing this key service. We know not much is there within a tax framework. This actually route. The only route is really to apply for exemption through first schedule, but it's not a walk in the park. You really need to support that. the institution you're running is of public character, and that any revenue or profit that you earn would be used to further that up. So from a private perspective, or rather private school perspective, not much has been done. I would propose, or rather I would ask the players in this sector to maybe